Welcome to The Road Less Traveled with Tiffany Rosenbaum. This podcast is about sharing the success and failure of entrepreneurs. Join in and learn from others' mistakes so you don't have to go through the same hardships in business. Now let's welcome your host, business coach, real estate investor, and proud wife and mom, Tiffany Rosenbaum.
Welcome to another episode of The Road Less Traveled. We are excited to have not only someone that is a great friend, but a special person in the industry, Dr. Newell. And I'm going to say doctor, she does have her PhD. She is an executive consultant, property management expert, and one of the industry leading voices in operational excellence. Not only has she owned a property management company, she has sold a property management company, and she has helped dozens and hundreds of property management companies scale their divisions to exceptional operational efficiencies. Deb, we are so incredibly excited to have you here today.
Thank you. I am so happy to be here.
Yeah. So one thing that I would love to discuss today, because I think it's very prominent in the industry today, is you have helped a lot of property management companies sell their operations, but also people buy operations. What is the number one mistake you see happen during these sales and these acquisitions?
Okay. Well, I think we need to break it out on both. Let's just do it with both sides. So probably the number one thing I see for somebody that's selling their company is the emotional attachment. I wouldn't say that's the number one mistake, though. It just is a natural occurrence to feel that your company is worth more than it may be worth. So accepting the valuation that comes from a broker or an advisor that's doing that valuation is going to be critical, and obviously understanding the why behind each of those numbers is going to help set that stage and really takes the emotion out, and then accepting that number. But keeping in mind, each buyer also does their own valuation in their own way. So you can have 3 different buyers for a company and they're all going to value it very differently, but probably all within a same range. There's usually a pocket that I would say it would fall into. So for example, when I'm doing valuations, I give a range and I'll do several different types of valuations to let them understand this is where we're getting the number from. This is what an EBITDA would look like, an SDE would look like, a per door would look like, a top line would look like. So we're kind of putting that all together. And then based on the type of company, what they're really selling, if it's just the book of business, if it's the assets, whatever, then that all kind of plays into it. And also understanding the mindset of the seller. Are you staying? Is this, are you kind of like selling and getting out? Are you wanting your employees to be part of it, the deal? Because I'll have some people who are like, my employees need to be secured with a job, et cetera. So if there's a lot of, I would say exceptions like that you're putting on the sale, that can change the dynamics. So you have to be very objective, try to take the emotion out. Mark Cunningham says it best, where it's really, is this a baby or is this an asset you're selling? Is this, a business? Because if it's your baby, it's just going to be a hard sale all around. And people tend to just get so emotionally involved in all of this, it makes it very difficult. So I don't know if that's like the number one mistake, but I think it's a cautionary tale of be careful and then be okay, because once you sell, you're done. So you have to be okay with the final number as well. And if you're not and it doesn't feel good, then don't do it. So maybe that's part of it. Now, for the buyer,
you said that before you go to the buyer, because I think there's a lot here. Now, Deb, when you go and walk in with someone and they're like, hey, I want to sell, and you find them attached to it and it's their baby, what's the first discussion you have with them first? And then second, a lot of people are attached to their businesses like it's their everything because they've worked so long. So what do you do to try to get them to go, hey, look, this is an asset. You've got to be okay with this if we're going to walk through this journey together.
Sure. So I think the discussion has to gear towards what are you planning to do after this? So again, there's a lot of things that can play into that. Some people are just like, I just don't want to do this anymore. I've tried it. I want to try something else entirely different. So if they have this plan B or a thought of a plan B in place, it is an easier conversation to say, okay, not everything is going to be wrapped up. Now, if they're counting on a big paycheck to help them with this plan B, that could be different. Like, I want to go start a cookie franchise, right? Well, that's completely different, totally fine. What are you hoping to get from this to help you do that? And, or if they're literally like, this is my retirement, this is what I need, I don't have anybody as a succession plan, this is what I need to do, then that also plays into it. So I think the part is we have to have a really, a gritty conversation to say, this is reality. This is no longer yours. Think of it as when you are a realtor and you're selling a house, and that emotion. This is why I actually really hated this part, and why I stuck with property management, because I just could not deal with the emotions of people wanting to look at 20 houses, or selling their house and thinking we put so much into this room, and I'm like, oh my gosh. So it's the same thing, really, that emotion of this is no longer going to be yours. Mm-hmm. Now, a lot of people are worried about that reputation, right? These owners, I don't want them upset with me. I nurtured them. I've held their hand. You're no longer going to be there. Even if you stay 3 months, 6 months, a year, even if you stay longer, it's not yours anymore. And so that relationship, if everything's just built on that relationship, that can be damaging to the buyer, who knows this, by the way, and is probably also taking that in as a risk consideration. So I mean, it's really having this heart to heart to kind of say, can you get out of this mindset of emotion? And if they can't, it just might not, what is the alternative? And it's kind of helping them face that and helping them understand this is what you have going on.
Yeah, that's a really good say, because there's a lot of people that get emotionally attached to their businesses, and especially the part where you were talking about the owners. Like, a lot of people, when they go to sell, they're like, wait, I want my owners taken care of. I want to make sure my reputation. And I totally, 100%, I would want the same thing. But at the end of the day, sometimes when you walk, you have to be willing and okay with they're taking the business over. How they do it, whoever you sell to, it is their business now. So you don't get to dictate that relationship. So, okay. So what about the buyers? The buyers that are coming in, what's the number one mistake you see them make?
They try to undercut a seller because they think they can. And, and I get it. It's business for them, right? They're looking at the acquisition for doors, growing a bigger business, totally fine. But I think it goes a long way to offer a fair value and understand the mindset of the seller. And this sounds a little, I'm not trying to be flippant when I say, what's a few $100,000 more? That's it. In the end, it's also what's the right thing to do for the seller. Now, again, understanding the mindset of the seller is going to be really important for the buyer, because that will also dictate how the rest of the transaction happens, right? Some sellers are very unrealistic, and it makes it very difficult. And yes, I'm going to probably offer you just below market or at market, because you're making this a very hard transaction. It has maybe even nothing to do with emotion, but just because they're not playing fair themselves. So, if you have a seller that doesn't really care about the business, then, but they just want out of it, once you know some of these details, it's very helpful. So I don't know if there's the only thing is on a buyer side is just play clean and be fair and equitable for both sides.
I think that's important. Like you said, be fair and equitable. Also create win-wins. When you create win-wins, both people come together, they're helping out. And when they separate, it's not it's not animosity. It's a win. They're both walking away happy.
Well, it's not even animosity towards the buyer and seller. It's animosity with the owners that the contracts you're buying. So this is a very risky transaction. In the end, it's very risky, and buyers know this. And sometimes you have to account for that risk and build that into the buy part. So yes, you may come in under because of the high risk, and that again depends on contracts and expiration dates and is 25% of my portfolio with one owner, is 50% of my portfolio with one owner. Those are really important factors to know that I am starting to see buyers ask more of, which is really good because that changes the dynamics of the deal. And how the whole thing is put together, because that's a huge risk. And if there's a lot of that, and the other risk could be, again, the seller who's like, I'm out, I just want to get out, I want to go start my cookie business or whatever, I need to not be here for more than 6 weeks. That's another risk. So that risk has to be accounted for and would come out in the price. So I can't fault a buyer for wanting to say, hey, I'm going to offer you 10, 15% below maybe the market or what somebody, because you want out so fast, or you're asking for no clawback or no, I want it all up front, like no tranches of payments. And so all of these things play into how much is going to be offered. And again, still trying to make it a fair and equitable deal for both sides, because each side wants a deal in their favor, but it's also a business transaction.
It is a business transaction. And earlier you went into the different types of evaluations. I would like to discuss that, because it used to be like price per door. I see that going away. Do you see that going away and going into different evaluations?
It really comes into play when a clawback is part of the deal, right? Because you do still need to figure out what that price per door is. So that still factors into it all, but not so much up front as the deal. I have my own school of thought on what really should be like the valuation factor of what you use. A lot of it will depend on the market and the door count size. So if you have less than 700 doors, you're probably not going to get an EBITDA number or understand the art behind the EBITDA number so much, because it really doesn't play into it. Somebody with 300 doors is not going to sell at an EBITDA price. That doesn't make sense. It's not going to be it's going to be in the buyer's favor, but not into the seller's. And so that number really comes into play when it's a larger transaction, both in revenue and in door count size. I just use a door count size because I think it's easy for people to relate to. And that in turn, is like millions in top line revenue when it's like 700 plus doors. You can still get millions in revenue at 400 plus doors, but you just, again, it's that, what is our revenue per door? That plays a factor into it. I get a lot of people who will say, well, I was really hoping for more, so if I hold on to it for another year and I really work on changing my contract terms, will that change the price? And I'm like, by a couple $100,000, maybe. But no, really? Are you going to just buckle down? Part of me just wants to say, why didn't you just do this before? Like, why all of a sudden? There's this old saying, which sort of applies to this, but doesn't, but it's like one of my favorite sayings: don't step over a dollar to save a dime. And it applies in the same way of you're kind of losing out on this one opportunity. We don't know what's going to happen in a year. It's like the stock market. It's going to change drastically. It could change in a month. We could have another COVID. We could have so many other factors that environmental factors that play into what the value is of our company. So you're hoping that in 1 year, I don't know, what are you thinking? That you're going to get $1 million more, $500,000 more? Like, what is the expectation that you weren't happy with today? This is, again, the emotional thing. Well, I was really hoping to get like $300,000 more. So changing your contract that you haven't done yet, that you now have to give at least a 30 or 60 day notice to, depending on when you're doing this, right? average is going to be around 45 days before you even get that contract term change. We all know that when you change a term in a contract, whether it's with an owner or on the resident side, you won't see those results for at least almost a year. Like it's going to take
and
some
sometimes it takes
time to
longer than
like,
that.
well, yeah. So even if you think about it, like I have a client right now who never charged, like, and this isn't an acquisition sale or anything, but she never charged placement fees ever. But, you know, she realizes the importance of doing this now. We've talked through it. So she's going to implement that. And she's, you know, taking some baby steps. So she's just going to charge something. Like she's never charged anything. So to her, something's going to be great. But she's not going to see, I mean, keep in mind, this is when a unit becomes vacant.
It does.
So,
it takes time.
So it's going to take some time. She's not going to see like instant. She is with some people, yes, but not right away with like hundred thousands of dollars. In, you know, maybe at the end of a year she'll see something, but it's going to take some time. So I think we have to really, you know, in 1 year, is that dynamic going to change? That buyer may not even be there anymore. So say la vie to them and be okay with somebody else who may have offered you less. I don't know. Again, that's where that saying comes into play. Like it's a saying of greed, right? Are we really just being greedy? But again, if you have the time and you were just exploring and really not needing to sell, that's a different scenario. But if you were like, I need to sell, my health isn't great, I'm getting older, I want to go start something different, what I need to move. There's so many different factors that you have to just, again, look at it, try to be as objective as possible. That's why when I come in, I mean, it really helps to, you know, I'm kind of mediating this whole transaction and really counseling both parties to help it go through, and really working with the seller on the emotion. I mean, I want them to get a really fair price, but I also want them to not be like have regrets. So as an example, I sold my company several years ago, and it's been a long time actually, but I look back at it now because people are like, oh, you must, you know, are you happy with what you got? And my answer is always, I am very happy with what I got, because I can't, I mean, first off, the deal's done. I can't have any regrets at this point, but I think I did a really good job in negotiating what I wanted. But I also have the personality to not have a lot of emotion into anything. And I'm okay that if that was all I ever got, that was going to be what I walked away with. Now, for me, I have money into this other company. It's not a secret. So if they do well, great. If I walk away and I get back what I put in, okay. If I get nothing back, what I sold it for was what I sold it for. I can't go counting on some future unknown that may or may not happen. I don't know. Or it's going to take years. I have to be okay with that.
100%. And, you know, a seller that's wanting to get an evaluation that is so much higher than what the market will be or what the market will bear. It's almost like an owner coming to you and say, hey, I want to get $3,000 worth of rent for a $2,000 worth of rent property. You know, it's that same discussion, the reality of what needs to happen. And the buyers need to, you know, pay what is market. But let's go into the evaluations that you see really happening. We talked about price per door. What other EBITDA, you talked about that. Do you see the cash on cash coming into the market?
No, not a whole lot. I think seller financing is still probably number one.
Okay.
Even for people who have the cash, they may not. Again, I think the deal size is going to play into this, right? If I'm buying 48 doors, I'll probably give you all cash.
Yeah.
But if I'm buying, 200-300 doors, why not? For both parties, it's actually very beneficial to do seller financing or to have something stretch out even 2 years, maybe even at the end of 1 year. I had a deal that was probably just around 200 doors, and it was just a 1 year, we'll give you a big chunk up front and then take a year, which was very smart to do for various reasons, but it's really beneficial to both the buyer and the seller for tax reasons, right? If you get all your money up front, just think about that's the other thing you have to consider. What you're getting, how you're getting it, you've got to pay taxes on that. And that can not be fun. So for a lot of people. So even if now some people are thinking through this and then putting their money in some sort of fund of some sort to protect it and not pay taxes on it right away, or however they're doing that. But yet you still have to on some things, right? It's still a sale, and it's not like you're doing a 1031.
Right. You got to pay taxes.
So yeah, think about that transaction and what that's going to look like. So if you're asking for $500,000 up front, I'm just pulling out a number, or even 200,000. I mean, depending on what your tax bracket is, and most property managers do fairly well, you're probably looking at a pretty hefty tax. And if you're in a state that has state tax, I mean, it's like a little bit of a double whammy, right? So I've got state, I've got federal, I've got all of it. So by the time all is said and done, all subscriptions are paid for, you're totally 100% out of it. What are you actually bringing home? That also changes some of how we look at this and what we're facing. So, yeah.
But on the evaluation side, do you see the cash on cash model? The return, cash on cash. The evaluation, like evaluating how much cash I am putting in, how much cash I'm getting out.
No, I don't think, I think people are looking at it more as a multiple. Okay. On that end. Honestly, that's kind of the first thing that people look at is, well, what's my multiple on top line? Because expenses are what they are, and buyers are pretty savvy enough to know this is what I'm going to be absorbing and this is what I don't need. So they're looking at really, again, their opportunities on that top line that are not happening today, knowing that they're probably grandfathering in terms that are already in play until, so I think, but no, I don't know. I haven't had any deals where somebody's looking at it that way. Not to say that they're not, but I think they're just looking at it on first, what is this going, what is my top line? What am I paying out? What am I receiving? Again, looking at it with two different parties. And then the SDE is probably the most I see happening as a second valuation that's being looked at.
Okay. What evaluation do you like to evaluate property management companies on the most?
What? Say that again?
What evaluation do you use the most to value property management companies?
Again, I've done a handful of deals that are over 700 doors. Those ones I will do the EBITDA, I will do a top line to kind of give them an understanding of what that looks like, only because everybody just looks at it. And then I am anything under that, I'm literally doing the SDE, the top line, and then the per door, just to give it, because we're also looking at what that's going to possibly play out as a seller financing long-term situation with clawback.
Yeah, and what do you see happening with the price for property management companies? Because in the last year, it's started to go up and up and up. Do you see us hitting?
I don't know. I think it's kind of remained stagnant. I think depending on the market, I think there is a demand. There is, I think the demand has gone up. People are getting into the business more. There is more buyers than there has been in the past. I always tell my sellers, I literally just need to raise my hand and I'll have 10 LOIs in 2 weeks, depending on the market, right? Oh. So I'm closing a deal in a week, actually. And I had 6 LOIs. I finally had to put a deadline in to say no more, because I had people still coming to me going, I want. And I'm like, I had to cap it. And we just had to choose, because it was just every week I had more and more interest. And at some point you just have to say, okay, this is my sampling essentially, and I can choose from these 6. And ironically, the highest bidder, if you want to call it that, didn't secure the deal. And so I think again, depending on the market, is going to be a big part of it, depending on the growth opportunities, the opportunity of that business, and the reputation of that business that creates the demand. We can be choosy on who we want to buy, somebody who has similar values and treats the company the same. So do I go local or do I go national? National meaning somebody who's in multiple markets. Local meaning I'm just in this one and I really can't, maybe a couple different cities, but still in the same market. And so that gives the seller opportunity to really curate exactly who that avatar of a buyer is and give them opportunity. I have another deal that's going on right now that's taking a lot longer because it's a small deal. And though I would have thought it would have been a roll up, it's a very unique deal. So it's not as easy. I have some interest, but not as much as I would have thought originally. But it's almost because it's so small that even thinking it would have been a roll up, it's almost too small for them to care, like a larger company. They're like, not really what, for us to have a really good roll up, it needs to be over, 150 doors. So I'm learning as well the mindset of some of these bigger players that they're looking at. They have minimum expectations. If it's a new market, it used to be 300 doors. Now it's almost 500 doors before that. It makes it a viable buy for them in a new market. If it's a roll up, it needs to be X amount of doors. Again, each buyer is going to be a little bit different for it to make sense.
Yeah. And is it because it's more expensive to have team members for the roll ups for that 500? Because it used to be 300 and you used to be able to get a good sized team at 300.
I think so. I think it does. Oh, you mean for if it's a new market for them? Yes.
Yeah.
Because they have to transplant people or find people. And they also know that even if they're buying a company that has employees, there's still you got to match them. Like an employee has their own free mind. They may not want to go with the new company. They might have liked the small mom and pop company that they were in, the whole I could take off whenever I wanted. Now I, report to Big Brother type of thing, right? So I've got more rules and I have to submit PTO differently. Like there's all these things that come into play. For some of them, they look at this as a huge career opportunity. Like this is exactly what I want to do. I get to move up the food chain a little bit. Others are like, no, I want to go and be in a smaller company. And then others are, realizing that they weren't probably a very good employee and the truth will come out. And so they exit themselves or pretty quickly. So, but buyers know this. They know that they probably already have a team in place that could either transplant there or they're hoping to capture some of the employees already there. It's a risk. So, yeah.
All right. So the next question I'm going to kind of jump to another thing is on buyer side. How many people do you see coming in the industry not understanding that they still have to have a method to grow that area? Like they're just buying and saying, hey, it's going to be what it is. Is everybody coming in and really looking at, hey, there's a churn factor here. Don't buy the depleting asset. You need to have a salesperson that is going to continue to grow this thing or at least stay the same size.
So your question is a buyer looking at it? Ask the question again.
So how many people are coming in and making the mistake, and I would call it a mistake, not understanding that is a depleting asset unless
I see what you're saying. Okay.
You are coming in realizing you have to grow it.
Right. So I don't know. I don't think people are. Are you seeing that?
That they don't realize they have to grow it?
Yeah. Are you seeing that people come in and buy? I mean, well, it's funny because I don't know if this is funny. I think you and I have seen this more recently with somebody. So maybe that's why you're asking this question. Okay. So I would say I haven't seen it since that, but are there people who think this is an easy business, meaning easy money, yes. And I have seen, and I will say, I probably haven't seen it so much on the buy side, like the acquisition side. I have seen it more with people starting up property management companies thinking, oh, this is easy. How hard could this be? And we're all laughing, going, well, you have no idea. So I think I've seen it more that.
Okay.
But to your point, and probably where I think I know where this question came from, is yes, I have seen in the past people buy businesses, buy this business, buy into this business, this industry of property management, thinking it wouldn't be hard. But I don't see that a lot lately. I really haven't, not in a few years. And although not to say I haven't had conversations with people where I call them CTJs, come to Jesus moments, to say, hey, buddy, do you really know what you're getting into? Like somebody who's come from the cookie business wanting to get into property management,
my goodness,
right?
yes.
So, thinking, well, it's just like running a franchise. It's just like doing this. Or I have seen people buy into franchises, and there's multiple out there, thinking that they have the franchise support. It's not like a McDonald's franchise or any other type, like a crumble cookie franchise. It's very different. There is support on the franchise side, but I don't think it's to the same level as you would see, because you're not paying $1 million for a McDonald's. So I don't know. There's a lot of that too. I think there's these unrealistic expectations from some people, and that can play into it.
I agree. I know I've talked to multiple of the bigger companies, and some of them they budget 20% churn. They think they can get better than that, and so if you're buying into companies, if you're not careful and you don't understand their churn, you could be going down and set it up, or even staying the same if you're not careful. And I think what you said is probably a better way to say it, Deb, is that I don't think people understand how hard this business is, and how many emotional people you're dealing with, right? Because even the owners that you're coming in, if they're not true investors, a lot of times they're very emotional. Like, they care a lot. And even the investor side, they care on a different level. It's not emotional, but it's facts. It's more like, where's the bottom line? And that's all that matters.
Right,
and
right.
I think people don't always take that into account.
Yeah. And yeah, that's probably the hardest hurdle. Maybe it's a hurdle. I wouldn't say it's a mistake, but maybe the better thing is to say the biggest hurdle is just stepping back and looking at this very differently. Yes, you care about your employees. Yes, you care about your owners. But you really have to think methodically through all of the steps. It's not just, can I get a good offer from multiple buyers? It's also thinking through, I've got expenses I'm going to have to, phase out that some buyers may not absorb. So what is that? Subscription costs, things like that. Office leases, people don't think through. Cars, am I going to have to buy that out? Is the person going to so there's so many things that we put into our business to make it what it is. And when that doesn't get sold as part of the book of business, that there's a cost to that, to the person who sold it. Also, am I selling the name? Am I selling the domain? Am I selling, what's all involved in the sale? And some people might just be interested in, I actually have another deal where they're like, I'm interested in the domain also, but nothing else. Book of business and domain. So there's value in that. So you have to think through, what is that going to end up costing? So sometimes, and then I've had, you've known this, I've had deals where the office space is owned and they want that to be sold. My advice is try to keep some things, separate transactions. So the book of business is one thing you're buying, but if you're not buying anything else other than maybe the book of business, a domain, and an office space, I would probably even go so far as you could probably put the domain with the book of business sale. But remember, if you're going to have clawbacks and other things in there, that really changes the terms of the contract. And that doesn't really play a factor into the office building that you're buying. So that should be a completely separate transaction, because that's a real estate transaction that's longer term hold, not to say that this isn't a long term hold, but it doesn't have any clawback clause with it, which then can muddy the whole main contract and people can get all, Twitter pated about it.
It's true.
That's a word.
It is true. So, Deb, for someone that's looking to sell, what's the best advice you'd give them?
Just like you would with anything, like if you're getting your taxes ready, just get all your things in order, like kind of get your house in order. You've heard that term. Get it all in order. Understand all of your software subscriptions, all of your utilities thing, like everything that goes into running your business. Look at what that's going to cost you to exit out of all of that. If nobody else buys anything else and they're like, hey, we're on the same software, I don't, or even if they're on a different software, that's not, like, when is that term over? Can you negotiate out of it? Do you have to buy out of it? Like, what is that? Or are you going to sell it to the other buyer? Like, you need to know all of this. So people in this business, we love it one day, we hate it the next. We love it one day, we hate it the next. I mean, that's very common. Even for seasoned people who've been in this for a very, very long time, we still go through those emotions of, I hate it, I want out, I'm going to burn it all down. I can tell you, but when I sold, I think it was kind of, I don't want to say it was on this rise of everybody starting to buy, but it kind of was. I didn't realize that somebody actually would buy what I had. I'm like, you want to buy this painful thing that I deal with every single day? Some days I love it, some days I hate it. And it has nothing to do with, the art of the management itself. Sometimes it's the people I'm dealing with, the residents, the owners, even my employee. Like, it could be a combination of anything. Just, I woke up in a bad mood. I didn't want to do it anymore. So there's a lot of emotion that goes that's involved in it. You just want to make sure you really think through your reasons, and then what is it going to cost me to get out of this, outside of somebody buying it.
No, that's a good train of thought. Now, other side, if someone's looking to buy property management companies, what's the best advice you give them?
There's a lot of buyers out there. I don't think we're at a shortage of people who want to buy. I think it's looking at what your hope, that end state is going to look like for you. That's probably harder to say, because I think there's so many buyers as offering what's the best advice is, are you trying to here's probably one of my best advices is stick to the market that you know best first. Grow that to a point, then maybe go into a neighboring city, then maybe think of going outside of that. Because it's a lot of work when you are buying a business, you're possibly doubling your portfolio size overnight. So remember your team that you have today and their capacity, and be cognizant of that.
Yes, I love that you said that. We grew and we didn't realize even it was a bunch of stabilization mode. Like, hey, how do we stabilize? How do we stabilize? How do we stabilize? We grew 122% last year, and realizing during that we're still stabilizing a little bit because we transitioned softwares. And the only reason why we were able to do that is because we had a large team and we were overstaffed.
Yes.
And so often in property management, this, they do the bare minimum of staffing. And so all of a sudden your team's already at capacity. And if they're already at capacity, I can't even imagine trying to buy another PMC at capacity. That'd probably take me down if I did that.
If you don't know your team well enough to know that one more door might break them, then you have a problem. Because what if they quit?
Yeah.
And to think that they won't is probably not wise. I don't want to say you should always go into this thinking that, they could quit anytime. I mean, they truly could. But to go into this thinking, they'll never quit. I know they love their job. They tell me how much they love their job. Life happens. There's things that are outside of our control that that may factor into why somebody leaves. It has nothing to do with you. It just has something to do with something else. So should any key people leave, what's that going to do to the business?
Yeah. I have many stories of that. Lucky I got to keep some. And you know about those. But Deb, I want to be respectful of the time. I know you're incredibly busy. Where can people find you if they want to buy a PMC or if they want to sell their PMC?
Yeah, so there's a couple things. So one of the things I actually started about 4 months ago. So I do a lot of, I mostly do it on the seller side. I get a lot of sellers that want to sell. And that, I'm consulting them and I'm working through, and I'm obviously handling all of the negotiations and mediations, the LOI, the PA, all of it, the due diligence, and then all through closing. So that's part of the consulting piece. But I did start a company called PMX Marketplace, where I call it like the Buy Biz Sell meets Kelly Blue Book. It's really where a listing site for property management companies and for buyers to go and look at property management companies. I think I have 3 on there right now, but those have rotated over time in the last 4 months. But there's it's a place where you can get a valuation. It has all the tools and the resources on even how to write an LOI, how to write a purchase agreement. All of that is on there, like checklists on what you should have. So that's a place. It's easy. It's pmxmarketplace.com. If you're looking just to sell anonymously, you can do the deal on your own. It's free. There's no cost to it. If you want my help, then yes, you can contact me through there. But then I have propertymanagementconsulting.com. You can reach me through, and I'm happy to have a conversation just to even give you a high level. This is where I think you're at, and then discuss options there.
Awesome. One last question before we go. What is one book you would recommend people in the property management industry that are running a business read to help them?
It's called QBQ. I had it right here. I think I put it away. It's not really a property management, but it is a book. It is a business book, but it's probably like, I always joke, it's like the easiest read. It's like really, thin. It's an oldie but a goodie, and I mean old, probably from the 90s, maybe even before that. The font is like 14 point, so it makes it so easy to read, and the pages are like this big. So, but it's a quick read, but the idea is, Simon Sinek talks about like the why, right? Mm-hmm. And I firmly believe you should always explain why you're doing something to your employees, to your owners, to your tenants. Like, this goes a little bit further to say, what's the question behind the question? So QBQ, question behind the question. So it helps. I would say it helps you get on the path of critical thinking skills. I had my whole team read it when I had my company, and it helps them know ahead of, like, what is my owner going to ask me next? So instead of like dreading this owner phone call, it kind of teaches them to be more prepared for, if I was in their situation, what would I be asking? Now, you may not know all of the answers, and that's okay. Just, we'll get back to them. But it helps you understand the psychology a little bit of where are they going with this, and bringing that back. That's
I like it. I'm going to have to look it up. I don't think I've read that one. I love Simon Sinek, though. I love his thought process, everything he teaches. So anyways, thank you so much for coming on today, Dr. Newell, to be with us and to explain, between buyers and sellers and help people out there, because I know there are a lot of people right now that are wanting to buy and wanting to sell. So we appreciate you. Thank you.
Thank you. All right.
Thanks for tuning in today to The Road Less Traveled. If you're organizing an event, workshop, or simply planning something exciting and would like to have Tiffany Rosenbaum join you, or want to have her on your podcast, visit TiffanyMRosenbaum.com and click on Book Tiffany to get started.